FTX's balance sheet has raised some eyebrows in the crypto world. When clients bought tokens and held them at the exchange, FTX only kept a small proportion of assets that matched those tokens. Given the questionable nature of these statements, it's puzzling how FTX was able to secure investment from major venture capitalists. Join us as we dive into the controversy surrounding FTX and its game of catch me if you can. This is V-Circle Future. In this episode, we will explore the largest component of FTX's balance sheet, tokens, which totaled $15.4 billion before the collapse. First, we will provide a brief overview of token accounting and then delve into the details of the token stories. Token accounting is a complex and evolving area, with a lack of clear guidance on how to value and account for tokens. This can create challenges for businesses and individuals who are using tokens as a way to raise funds, invest in projects, or store and transfer value. To address these challenges, it is important for businesses and individuals to stay informed and work closely with their accountants and financial advisors. By doing so, they can ensure that they are accurately and transparently reporting their token transactions, which will help to build trust and confidence in the token economy. Obviously, FTX has not been accurate or transparent in its accounting practices, which has led to the collapse of the company and accusations of fraud. Someone argued FTX may have manipulated its financial statements. Here is how they may have done it. The biggest mysteries surrounding FTX are how it handled its own token and the value of the tokens. FTX treats FTT token as an asset because it's a tradable token and hence has value. If FTT is considered as a security token, it would not appear on FTX's asset side. A company would not hold its own shares as an asset on its balance sheet. If FTT is considered as a utility token, as one of the benefits provided to FTT token holders is discounts on FTX trading fees. It might be considered as a liability because FTX owes its customers future discounts on trading fees. In this case, a token is more like a coupon that provides a discount on goods or services. Real-world companies don't typically include coupons on their balance sheets. When a coupon is redeemed, the sale is recorded in the usual way and the discount is treated as an expense. Nowadays, many token issuers today avoid selling tokens through initial coin offerings, ICOs, or initial DX offerings, IDOs, in order to avoid violating securities laws. This is not the first time that token accounting has been called into question. In 2019, Animoca Brands, a major investor in NFT infrastructure and gaming, had its shares suspended from the Australian Securities Exchange, ASX, due to concerns about its token accounting practices. It's worth noting that in its latest financial statements, Animoca did not include its own reserve tokens on the balance sheet, even though the company has estimated their value to be in the billions. Why FTX put token as its assets? In the interview with Wall Street Journal, SBF tell us part of the story.
Right, you rewind to 2019, 2020, FTX didn't have bank accounts. And that was because as a global crypto exchange at the time, almost none of them were able to get, global banking. Some customers still wanted to onboard fiat currencies though. FTX was maintaining cryptocurrency wallets, but not banking accounts. And so some of them would wire money to Alameda. And then asked to be credited on their FTX account.
In theory, Alameda should have returned the money to FTX, but it seems like Alameda did not do so. Alameda invested the money in some crypto tokens to build the SBF's ecosystem. Some of the funds went to the following. First is FTT, a token used on FTX. Often described as the backbone of the FTX exchange, it provides its holders many benefits. Second is Solana, SOL. It was a relatively new blockchain network, founded in 2017. It is designed to host decentralized, scalable applications and can process many more transactions per second and charges lower transaction fees than rival blockchains like Ethereum. I'll buy as much SOL as you have right now, at $3. SBF hyped Solana frequently for years, both personally and through FTX. Thereafter, SBF created a decentralized exchange software, Serum. It was built on Solana and was designed to automatically match buyers and sellers. By being deployed on Solana, Serum can fully benefit from the speed and cost-effectiveness of transactions settled on its blockchain. Also, bankman-fried was created to support a project that aimed to develop trading tools for Serum. In addition, tokens from two other companies, Oxygen and Maps, were also connected to Serum and backed by Alameda. Oxygen is a brokerage that offers loans to traders, while Maps is an offline mapping service that planned to attract customers using a wallet feature within the app. To strengthen the whole ecosystem, SBF had to build up the market confidence and hype the ecosystem frequently. Meanwhile, the quickest way is to boost the price of those tokens. Alameda started to manipulate the price of those tokens by continuously buying them in order to inflate their value. They then used these overvalued tokens as collateral to offset their debt with FTX. According to statements made by Oxygen and Maps, FTX and Alameda held a combined total of 2/3 of all possible Serum coins. In addition, much of the trading in Serum was driven by Alameda, and the company's backers stated that their goal was to imbue Serum with incredible liquidity. Oxygen and Maps also reported that FTX and Alameda held 95% of all of their tokens. A similar story seems to have also happened with FTT tokens. Who owns the most FTT tokens? According to data published by CoinCarp, as of November 18, there were a total of 24,244 FTT holders. The top 10 holders of FTT held 93.63% of the total token supply, while the top 100 holders held 99.35%. One anonymous wallet owned 59.55% FTT tokens, making it the largest holder of FTT. Another wallet 13.94% of the total. The fact that such a large proportion of the tokens are held by a small number of entities suggests that the distribution of tokens could be vulnerable to pump and dump schemes. So, without the support of Alameda and FTX, the ecosystem envisioned by SBF is crumbling. The day before FTX filed for bankruptcy, the value of FTT, Serum, bankman-fried, Maps, and Oxygen tokens experienced a sharp decline, reducing the value of these assets on the exchange's balance sheet by more than half. One more detail is, prior to November, FTX did not include all information about these tokens in its balance sheet. However, when FTX faced a run by customers and struggled to raise cash early in November, billions of dollars worth of collateral from Alameda Research appeared on FTX's balance sheet in an attempt to convince investors of its financial health. Unfortunately, this move did not save FTX and instead made things worse. It was later discovered that the valuations given to some of the tokens on the balance sheet appeared to be exaggerated or even fictitious. The Serum and Maps tokens are shown as assets with valuations that are many times greater than the current market capitalization of these tokens. For example, the Maps token is shown on the balance sheet as being worth $616 million, more than several hundred times the token's recent market cap of $1.36 million, and even higher than its all-time high market cap of $117.37 million. This seems unrealistic. Why was this happening? Many token issuers have large token supplies, and they release the tokens gradually over time. But here, they extrapolate the tokens much more aggressive. Do you think the way they extrapolate these tokens to a much larger supply logical? If a listed company had 100,000 shares in circulation and suddenly issued another 10 million shares, would the stock price remain the same? Of course not. FTX and Alameda also bought a bunch of tokens untradeable until a specific future year. Those tokens are totally illiquid. Okay, we hope you have some ideas of where did the money go in the collapse story of FTX. Recently, SBF has started a media tour and given interviews to the New York Times Dealbook Summit, Good Morning America, New York Magazine, and Wall Street Journal, etc. However, many people in the crypto community feel that SBF has not provided many concrete answers in these interviews and that he is being portrayed as a well-intentioned person who made an innocent mistake. Some are questioning why SBF is being treated so gently. SBF has denied committing fraud and has stated that he didn't knowingly commingle funds and didn't know the operations of Alameda. Do you believe what he said or not? Let us know your thoughts in the comments section below. This is V-Circle Future. Thanks for your watching.